The Bank of England has kept interest rates unchanged at 3.75% at its first policy meeting of 2026. The move highlights a cautious approach as policymakers weigh easing inflation against signs of resilience in the UK economy. The decision was finally balanced, but policymakers hinted at pressure to begin easing monetary policy after December's rate reduction. The pause reflects mixed economic signals. Policymakers expect price pressures to ease in the coming months, with inflation projected to move closer to the 2% target from April. Monetary policy is now focused on ensuring that inflation not only returns to target, but stays there on a sustainable basis. Financial markets reacted swiftly. Sterling weakened following the decision, falling around 0.6% against the dollar. Attention has now shifted to upcoming inflation and labour market data, which will be critical in shaping the policy path ahead. Economists broadly expect the next rate cut to arrive in the spring, with April emerging as the most likely window. Some forecasts point to a gradual easing cycle through the rest of the year, while others suggest the bank may move cautiously. The broader economic backdrop remains challenging. While early 2026 data points to stronger demand than previously expected, price pressures and subdued growth dynamics continue to exist. Experts say this mild stagflationary environment has left policymakers divided and reinforces the case for a measured approach on monetary policy. For now, the Bank of England is signalling flexibility rather than urgency. Rate cuts are likely, but their pace and timing will depend squarely on how quickly inflation cools and whether signs of economic slack become more pronounced in the months ahead.